Everyone, this is Dr. Saburi again. As promised, today I will do a video about how I analyze real estate deals and the calculations based on which I usually make my decision about buying or selling a property. Keep in mind that this is purely based on numbers, what I'm showing you. In reality, of course, some other factors play a role, like the neighborhood, the condition of the house, any projected repairs that might happen soon, and things like that that need to be taken into consideration, on which I will not touch today on those topics. So let's assume the neighborhood is already good enough neighborhood and things like that. So I'm doing this based on a property here located in 640 Elm, unit number 16, located in downtown Long Beach in California. Let's take a look here. The Redfin estimate says $272,029. As you see, each website has a calculation. For example, Redfin calls it Redfin estimate, or Zillow calls it Zestimate, which is like a, if you want, a computer generated value for a property based on, records, sales records in the area and the data that the computer get in. Here we have the estimate of $255,000. Redfin shows a higher price, $272,000. Those and you have here also like a range from 259 to 286 and so on and so forth. So those values can be usually up to 20% off, in my opinion. So it can be higher or lower. So that's something to keep in mind. So don't take those values too seriously. It's good to give you kind of an idea of what's the property value in an area, but don't take it by any means like as an accurate estimate. It's just something that the computer calculates. It might become more accurate down the road in the next couple of years, but as of now, take it with a grain of salt, plus or minus 20%. I'm assuming here for simplicity, or to have some sort of rounder numbers, let's go with $300,000. Property value, those are the numbers that I assumed. I used here for a template of Excel that seems to work fine. We will see. I'm using this for the first time myself. So I started to write down here some numbers. Property value $300,000. I am assuming a long-term value appreciation per year of 3.75%. Typically, I would say 3% is very conservative if you're planning to hold the property for a longer term, which I recommend. The transaction costs with buying and selling properties are so high that you should not buy a property if you're planning to sell it again in a year or two, or if you need the money in a year or two and you would need to sell it. So you need to plan to keep the property at least, I would say, more than 5 years. Ideally, um, 10 years plus. I'm assuming right now a value appreciation of 3.75% per year. 4% is, I think, relatively realistic, depending on the area, of course, and other factors, but somewhere between 3 and 4%. There's there has been a lot of money printing happening with the Fed in the recent months, as you know. So 3.75 is, I think, not a bad estimate at all. I assume here 20% down payment. The reason is if you put in 20% down payment, you can still buy deals, but you have to pay the so-called PMI, which stands for private mortgage insurance, and that is about 0.5%. So that would jack up your interest rate by 0.5% if you can't come up with 20% down payment. So if you're close to 20%, I would recommend to you just somehow get the 20% together. It's a whole different thing if you have only like 10% or so of the down payment. Then you might as well just get that PMI if you don't have the means to get the 20%. But I wouldn't do like 18 or 19% down payment. Just get that money somehow together and save that 0.5%. Okay, so mortgage interest rate, I went with a little bit of a higher number. We are currently, the mortgage interest rates are lower, but keep in mind we are at historically low interest rates. So probably if people watch it in the future, they are probably closer to 3.5%. And secondly, those interest rates that you hear that are advertised are assuming perfect circumstances. So you have an excellent credit score, and also the type of property is like the ideal one. Usually you get the best interest rates, for example, on single family residences. This one being a condo, you should expect a slightly higher interest rate, maybe 0.25% or something like that. So I'm just going here with 3.5%. Let's be a little bit more conservative. And then mortgage duration is 30 years here. Now, how do we calculate what is mortgage payment and principal and interest? There are many mortgage calculators out there. I'm using this one, but there are other ones that are good. So you put in the amount of principal. If my down payment is $60,000 at the property value of $300,000, it means the principal of my mortgage is 240,000. Interest rate is 3 point, what did I assume again? 3.75%. So 3.750%. So 3.75%. So this is the first number. So in this case, 3. And then this is after the decimal, as you see here, point, whatever is the first number after decimal, second number after decimal, and then the third number after a decimal. Let's say we are starting, it's a 30-year mortgage. Let's put the start date of the mortgage in the past, January 2020, so that it gets always round numbers. We know exactly by January 2050 the house is definitely paid off. And then we see the payment is $1,111.48. As you see, if you change the interest rate, the payment changes and stuff like that. So that seems to be correct. Let's just round it to $1,112. What I also do is I break it a little bit further down and I look into how much of that money is actually principal and how much of that money is interest. Now this part is a little bit tricky. The reason is that the way a mortgage is paid off is like this. So your total payment is $1,111.48. This red part is representing the interest over those 30 years. As I mentioned, by the year 2050, that property is paid off, assuming that you're always making the minimum payments. If you pay more, obviously it's going to be paid off earlier. So this red line is showing the interest that you pay, the portion of your money that goes towards the interest at any given period, essentially. And you can see it broken down a little bit more into the details. For example, in the very first month, your interest is exactly $750, and then the remaining $361 of the amount that you pay goes towards the principal. Now, the principal decreases by a small amount after the first month. So now you owe essentially $361.48 less to the bank, which means that accordingly on your next payment, on your second month's payment, your total payment is still the same, but a smaller portion of it, a slightly smaller portion of it goes towards the interest, and a little bit more goes towards the principal. So the difference is here like $1.13 or so of difference. But that kind of starts to add up. So with every month that you make a payment, your interest decreases a tiny little bit. Why? Because your principal decreases by a tiny little bit with every month. And so if we do a fast forward, in the first months your interest portion is $750, But if you look into the last months, it turns completely. What you pay goes mostly towards the principal in the last years, right? Look, for example, in the very last year, 2049, almost the entire payment goes towards the principal. Only a tiny little bit goes towards the interest. Only $40, versus in the first month it was $750. Look into the very last month, only $3.46 goes towards the interest. Why? Because your mortgage is almost completely paid off. There's barely anything to pay interest on. So that's essentially how it works. Now, when I tell you that I look into what part goes into the mortgage interest, principal and interest, well, that amount changes with every single month. So how do I do that? Well, um, uh, you would essentially kind of want to take an average, if you want, of how long you're planning to take to keep the place. The problem is we don't know in advance how long we are planning to keep the place. When I invest in real estate, I plan to keep it for a very long time. As I said, ideally 10 years plus, but you never know. Life happens and things might change and circumstances can change. So, what I do typically is I go, let's say, 2, 3 years into the future and look into that. So as you see, so after 1 year, your interest portion goes down to about $736. After about 2 years, it's down to $720. After, let's say, 3 years, we are down to $700, pretty much $707. So let's go with $700. I think that's not bad. So because after that it becomes less and less and less. But I go usually 2 years, 3 years, something like that in advance and take that value. So my interest is $700 per month, which means that $1,112 minus $700 is $412, is roughly going towards the principal. Now, we need to distinguish between two different types of calculation. One is maybe you want to look on the property purchase as a whole as an investment. From an investment perspective, how much will your money grow if you put that money into this investment? Okay. Um, in another, you could do also the calculation, a second calculation, which would be looking into the cash flow. So how much money would this property put into your pocket every month? Now, what I'm doing here is looking at it as an investment and not look at it as a cash flow situation. So as an investment, when I do that, what I usually do is that this amount that goes towards the principal, I do not count the entire mortgage payment as costs. Why? Because I look at only at the $700 essentially as costs, because those $400 every month reduces essentially my mortgage payment. My mortgage payment goes lower by about $400. I don't see that money today in my pocket, but the day I sell the property, let's say sell the property one day for $400,000, and maybe in 10 years from my $240,000, only $200,000 is left. So I would not get $160,000 back, but $200,000. Why? Because every month a little bit of the mortgage amount has been chipped off. So I will see that money one day, just not right now, but it's as if you can think of that money going into like a savings account, uh, which you cannot touch until either you sell the property or the property is paid off. So this money is not being lost; it's just stored for you, saved in a piggy bank if you want. So only that $700 is really costs. This is not. Now, when I do the cash flow calculation, right? I take the entire mortgage payment as, you know, that money that goes off my account. So cash flow wise, of course, I don't see this $412. So it's a different situation. But we are not doing cash flow here. We are looking into profit loss investment type of situation. Okay, so let's take a look. Rent. Let's assume that this property is being rented for $1,700. This is a one bedroom in downtown Long Beach, and it has also a garage. So the garage is very valuable in downtown Long Beach. So uh, it's not very unrealistic to assume a rent of $1,700 is actually probably more on the conservative side. Okay, and then you can see into the pictures the condition of the property, and then if you browse, you can see it's looks recently being remodeled. You see the floor that's all done new. You can even see here the the workers tools. They took the picture right after they fixed up the place, so it looks like in a remodeled condition. You can tell by the kitchen cabinets it's not a new property. These are the cabinets are older, but that's fine. Usually older cabinets are oftentimes very well, they can work still for many years because they used to use actually real wood in it. You can just repaint them. Sometimes you can just change those handles, which seems to be have done here. Just a more modern handle, and then it gives it a nice new look. You have here granite countertop and stuff like that. A new oven here, new sink, new stove, and everything. So that's nice. Bathroom in the same situation. The reason I'm looking into that is to have an idea of how much costs we should expect down the road in terms of repairs and things like that that might happen. If it's a brand new apartment, of course, you can expect less. If it's old, not very recently remodeled, you should expect more, and so on and so forth. So for this one, for repairs, I put in $50 per month. Keep in mind, if it's a single family house, you should calculate more for repairs uh, because things like roof, that's very expensive, needs to be replaced, and so on and so forth. But when it's an apartment in an HOA, the HOA usually takes over the cost of everything that's exterior of the house. So the outside walls, the roof, and things like that is taken over by the HOA. So it's covered by the HOA fees. So you have to pay those HOA fees instead, but you don't need to. You pay instead somewhat less for repairs to some extent. So because it's remodeled recently and because it's a condo, not a house, I think $50 is relatively conservative. That should do the job. In average per month. So you put that money aside, and for many months, maybe nothing happens and you don't need to fix up anything, but then suddenly something might break, and then you have to spend suddenly maybe $500 or so. But you definitely have to count on some money. You need to put it aside. Okay. Now, the next thing is monthly income. We are not done with it. Another thing that I take into consideration is projected long-term price appreciation. Now, projected long-term price appreciation, I assume that the property value goes up by 3.75%. Now, we have here again a little bit of a complicated situation. So, an appreciation of 3.75% means that if you multiply it with the property value currently of 300,000, means that in the first year the property gains $11,250 in value. Now that's a statistical average, of course. It's possible that you buy the property and there's going to be a crash immediately after that. And after the first year, maybe the property is worth only 260,000 instead of 311,000. The point is, again, I'm assuming that you're buying the property for the long term. You're planning to keep it, let's say, 7, 8, 10 years plus. So if you look at it that way, even if there's a crash tomorrow, there's plenty of time for the market to recover from this crash and eventually go back on the old path of growth. So yeah, that's the one thing that makes it a little bit tricky. But then the second thing is that we have the compound interest effect. So as you see, the first year it grows by $11,250, but if you multiply it with, again, 3.75% growth here. Now let's subtract it from the value of the previous year. It was 311,250, and then as you see, instead of 11,250, in the second year it grew by 11,670, and in the third year it will grow by even more, by over 12,000, and so on and so forth. So the growth should accelerate with every year that you keep the property longer because of the compound interest effect. Now the way I do it is I just assume the growth of the first year. I don't look into the that accelerated growth effect, just to be a little bit more conservative, which means the longer I keep the property, the longer will that accelerated growth effect be on my side. Okay. So I'm assuming with $11,250 annual growth rate, if we divide it by 12, that's a growth of around $938 per month. Well, you can't count on it, but that I'm projecting $938 per month. Again, this number is not reliable in the short run at all, but if you keep the property long enough, it will eventually be true, and it will eventually exceed it comfortably. So if you keep the property for 20 years plus or so, you would definitely get a much, much higher number than this $938 per month. Let me show you here an example. So 3.75% growth, which is represented by 1.0375, power 20, which is for 20 years. So it would easily, it should double, the price should double after 20 years. And if you look back, in the property prices, that has definitely happened in the past, that after about 20, 25 years, whatever, the prices have definitely doubled. And again, keep in mind that right now there has been a lot of money being printed, so that causes inflation. Prices go up, which means prices of real estate should also go up at a faster pace. So that's something you can calculate on. Now, it means that my $300,000 property, if I multiply it, should be worth $626,000, which means it has grown by $326,000 over 20 years. If I divide it now by 20, it gives me a growth of $16,300 per year. What was I calculating on? 11,250. So that's what I mean. If you keep the property for a very long time, it should comfortably exceed the value that we are calculating here. So this would be then rather conservative. But on the other hand, you should keep in mind that life circumstances can happen, and you might decide for one reason or another to sell it before 20 years. That's why I just don't look into that interest effect. If it happens, nice, that's a cocktail cherry on the top, or whatever you call it. And if it doesn't happen, that's fine too. My disappointment won't be big, because I calculate only with $938. But as you see, this is very substantial. This is very massive, and that's something many people might not really take into account, because they look only into the rent that they receive. But the property appreciation is also a big number, because look at what a large percentage of the rent it is. Next thing that you should also keep in mind is tax savings. Now, that tax savings depends on whether we are looking at a investment property or a property that's supposed to be your residence. You want to live in there because things would be different. If you live in that property, you can deduct interest that you pay on mortgage payments from your taxes. That would apply only if your mortgage interest is more than your standard tax deduction, which is 12,000 per year, currently under Trump tax. Once the Trump tax is reverted, because I think it's Trump tax is only until 2025, then the standard deduction would go down again. So again, I'm not a tax advisor, keep that in mind, but this is my understanding of the tax system. So currently we have a $12,000 standard deduction for a single person. Now, I make a high number as an example just to get it, somewhat above the standard deduction to show you how that affects. Let's say you have another $5,120 of other itemized deductions. So you have a total of $14,000 of itemized deductions. Now, standard deduction is $12,000. That's what you would have had anyway. So what you save additionally because of, having that mortgage, etc., is essentially $2,000. $2,000 is what you can deduct from your taxes, but then you have to think of in which tax bracket you would be. Let's assume you are in a 25% tax bracket or something like that. I mean, the tax law changes all the time, but let's assume there's a 25% tax bracket and you would fall within that tax bracket. And that means you have an annually $500 of tax savings. Now, if you divide it by 12, it means that you have a monthly tax saving of $42 roughly. Okay, so this is nice because it gives us a relatively round number of total monthly income from ownership of this property of $2,680. Keep in mind, you only see that $1,700 really coming into your account, and then this $42 you don't really see it, but you actually save it because you end up paying less taxes at the end of every year. And this is something you don't see until you are essentially selling the property. But at the end of the day, if you keep the property for a longer term, this is gonna give you an income of 2,680, but we still need to subtract, of course, the costs. Now, mortgage interest is probably a big chunk of the monthly expense, which is $700. Property taxes are, so the way I think of property taxes, it's usually around 1.2% annually, maybe a tiny little bit more, but I go with 1.2% because it's very easy to calculate. 1.2% annually is, if you divide it by 12, is 1 out of 1,000 per month. So the way I think of property taxes is very easy. You take whatever is the purchase price divided by 1,000, and that's your monthly property tax. So if you buy the property for $300,000, your property tax is going to be $300 per month. I know that's a lot and that's painful, but yeah, it is what it is. Then HOA fees, the HOA fees of this property, you can always look up HOA fees in the MLS description. It usually says somewhere. So single family residences oftentimes don't have HOA fees. Here you see, by the way, the median rent is $1,750 per month. I calculated with 1,700, so that's not far. Here, HOA dues, you see $115 per month. So on that property, we need to pay $115 HOA fees per month. And then insurance, again, when it comes to insurance for houses, it's more expensive. If it's a single family residence, it's definitely, I would say at least probably $50 or so. And then the bigger the house and so on and so forth, the more expensive it is. Also, insurance might depend on factors like how close is it to potential fire hazard area or flood hazard and all that kind of stuff. So on condos, insurance is lower. Usually, I had it as cheap as I think like $15 per month or so, $16 per month, I think. Very, very cheap. Let's go here with $25 per month. That shouldn't be too bad. Repairs, I mentioned it already in the beginning. We looked into the pictures. The condition looks decent, so $50 per month. So before we look into the final result, um, let me make a couple of remarks. So I have one bad news and a couple of good news. The bad news is that some of these monthly expenses increase over time. So you should expect the property taxes to increase. Typically, property taxes can increase up to 2% per year. That's the beauty of it, is that even if the property value goes up by 20%, your property tax will not rise by more than 2%. So that's really nice. So that's another reason to keep the property for long term, because this property tax becomes less and less significant. So as a percentage, it becomes smaller and smaller. So that's good. That's on your favor. HOA fees will also typically increase over time, especially if it's unusually low like this. You should expect it to go higher. This is extremely low, $115 HOA fees. You should also look into the reserves before you buy a property. So that's another thing that you should take actually into consideration before you buy a property, because you should look into what you project on how the HOA fees will rise. I mean, what if you buy it and next month it jumps to $200, right? Because there are very low reserves in that association. So that's something you would need to look into to kind of have a projection for the HOA fees. If you think that it will jump high, you should put in the higher number, maybe let's say 160 or something like that. But this one looks like relatively healthy, so we can go with the $115. Insurance also rises usually, and repairs. So these things, these four parts, you should expect them to rise in the cost factor. However, on the bright side, the biggest chunk of your monthly expense, which is typically the mortgage interest, that remains stable for the next 30 years until your mortgage is paid off, at least if you have a fixed rate mortgage. So that's nice. The biggest part of your expenses remain stable, and also the rent. No, when you live in that property, you're saving essentially $1,700 rent that you would have paid otherwise. That rent also usually rises. That's also something to take into consideration. So that usually rises by more than these things combined rise. So over time, everything actually starts to work more and more in your favor. That's why the number that we see is essentially for the first 1, 2 years, 3 years maybe, but after that it's probably a higher number. Now, what is that number? Drum rolls, please. So yeah, what is my return on investment? You have $1,490 monthly multiplied with 12 is $17,880 annually. Does this property add to your wealth? That's not bad, 17,880, especially if you keep in mind that you invested only $60,000. So if you divide it by 60,000, it's 29.8%. That's why we can here have expected return on investment is 29.8%. There is another important thing I need to mention. When you sell the property, you will have high costs, right? You have about 5%, 6%, something like that of the property value is what you will be losing when you sell the property. That's another reason not to sell the property and keep it for a very long time, so that you paid only once in your life and not 3 times or something like that. I don't take that also into consideration, because especially if you keep the property for a long run, you have so much other benefits that play in your favor that we didn't, take that into consideration. Like this long-term projected price appreciation would be significantly higher than $938, and so on and so forth. So these property tax, HOA fees, and stuff like that rise at a much lower amount than your rent essentially income would rise. No matter if you rent out the property or if you live in there, it's the same thing. So even if you live in there, you are saving more and more money on rent that you would have to pay otherwise if you would have rented a place somewhere else. So all those benefits play so much in your favor that I think it's okay if you don't take the cost of selling into consideration if you keep the property for a long term. Yeah, that's how I calculate real estate deals before investing into them. Again, this is a simplified version, and it applies to deals where you intend to live there. If you want to rent it out, the math is a little bit different. On the one hand, you would need to add to your monthly expenses a line for vacancy and evictions. So keep in mind, tenant might move out and you might not find someone immediately. That's the one thing. I usually find really fast someone. I don't let properties be empty for longer than just a few days. But even worse is evictions. That's a nightmare. So if eviction happens, that's really bad. So what I typically do is I assume usually you should assume like 1 month rent as a backup for these things, vacancy and evictions. But because I usually don't have a long period of vacancy, I am going here with, let's say, 6% is I think decent. So again, that would change the math a little bit. You would put here 6% of this value you would put aside for vacancies and evictions, so that would be another $100. But on the bright side, you would be able to deduct not only mortgage interest from your taxes, but also property taxes, HOA fees, insurance, repairs. All of these things would be suddenly tax deductible, which is not tax deductible when you buy it for yourself to live in there. So that might, in one way or another, cancel each other out, at least to some extent. So that's how I calculate my real estate deals. It's very complicated. I try to keep it as simple as possible. Thank you very much and have a great day.